Alright guys, we have to talk about markets because things are starting to get serious. Bank earnings dropped before the open and the market did not like it. And when we look at the charts, we couldn't capture the crucial 5200 zone in the S&P 500, leaving us in negative gamma, potentially signaling the start of the pullback. And with gold rallying and bonds catching a bid, the safe haven trade is sending us a clear warning sign. So what is that warning exactly? Today, we're going to discuss that and geopolitics. Things are starting to heat up, and we need to talk about how to navigate such a volatile environment. We're also going to be talking about my portfolios, the undervalued portfolio and the public portfolio, the moves I'm making and where I stand with regards to gains. So guys, we have a lot to talk about. Let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video and leave a comment for the algorithm. It really helps me out. Let's get into it. This is the daily heat map of the S&P 500, guys. Brutal day. I mean, even your defensive sectors right here, defensives, right? Energy, utilities, basic materials, they got sold. These are your inflation hedge. These are your defensive sectors. Look at healthcare. They got absolutely sold off today. Today was a complete liquidation. Today was pull all of your money out that you can in the market just on a fear trade, right? The only green spots right here, insurance, right? Visa, Apple, American Express. They were really the only sectors, the only stocks that didn't really get hit. Other than that, it was very, very brutal across the board. Now looking at sector analysis for the day. So this right here, guys, this is GDX. Look at where it finished, up nearly 5% on the day, down 2%. That is a huge intraday decline. It had to do with what happened in gold. Then followed that by semiconductors down 2.92%. So very volatile day across the board. Look at this right here, energy, metals, mining, utilities. They were all positive at the start of the day. And then when the fear trade started, it was, we don't even want defensive stocks. We don't want equities as a whole. And that's why everything just got sold off. It was an actual liquidation today. The S&P 500 was down 1.38%. Out of all of the sectors, the best performing ones was utilities, home construction, KRE, XLP. You know, they were down less than 1%, XLP slightly over 1%. We also had XLF here, as well as real estate. XLE energy down 1.63% today. It was very, very mixed trade. And whenever you're doing a sector analysis, you sort of have to look at everything that was bought, look at everything that was sold, and then ask yourself, what is the market trying to tell you through this? You want to look at trends, you want to look at patterns, you want to look at similar sectors, what's been purchased, what's been sold, and there's just no trend here. The only thing that you could say was that stocks were sold off, equities were sold off, and to me, this screams liquidation. People just wanted to get out, and we're going to talk about why. Okay, so why did the market sell off? Well, there were rumors, and it's been going all this week, but it really started escalating that, and I'm going to try and keep this monetized. The rumors are that this country right here is preparing for this from this country this weekend. So something's going to go down this weekend. When you get news like that, people don't want risk on the table. They want risk off. What's the most risk off investment you can have? It's a 4% money market fund, cash in your bank account. At the same time, we got higher import prices as well as consumer sentiment data, missed expectations. This doesn't help the inflation narrative. And as a result, equity sold off. So it was just a whole bunch of things coupled together. And then we just saw liquidation. The second you see downside flows, the algos kick in, people get nervous, people get emotional. The zero DTE traders help with that, and in a negative gamma environment, dealers sell into weakness, so prices are going down and dealers are helping the move lower, and that's why we get the type of move that we did. Complete liquidation, complete selling, people just exiting stocks, getting cash, trying to feel good about themselves. That's exactly why the market sold off today. All right guys, let's break down these indices. Now look at this, the S&P 500, Nasdaq, RSP, mid caps, small caps, IWM, growth, value, even futures, right? Everything was down like 1.5 to 1.8%. We see a bit of upbeat price action here in growth after hours, up 0.44%. So this is stuff like Apple, Microsoft, Google, you know, pretty much the tech trade, com services, discretionary. Yields actually did fall, and that's because we actually saw bonds, especially government bonds and corporate bonds, investment grade bonds, catch a bid. And that's because it was a simple flight to safety. Now, looking at some of our other proxies, guys, Bitcoin down 4% on the day. Let's actually go on the daily chart. You can see massive squeeze down. So still in this very tight range it's forming here for Bitcoin, and it's sort of getting tighter, but we're seeing a bit of expansion of this range. Call it a bull or bear flag, whatever you want to call it. Then we look at gold, right? Down 1.19% on the day, from 2,400 down a full 100 points to 2,300, 2,330. Kind of crazy price action there in gold. So So, we saw this massive spike up and then all the way back down. We saw a very similar situation in oil. We hit this $88 in early hours trade, and then we parred all of the gains on the day, and then the dollar gained quite a lot. So definitely some things you don't want to see: the dollar gaining, oil gaining, gold gaining. Not going to be good for stocks. It sort of signals a safe haven inflation hedging trade, as well as the dollar rising. There's definitely some international risk going on in the markets right now, and that's just the thing, right? When there's geopolitical tension, people want cash, and out of all the currencies in the world, what's the best currency? It's US dollars. When there's a flight to dollars, people are going to go to US dollars, and that's why the DXY was bid up, because US dollars is the reserve currency. It's the best currency to hold in times like these. Now, looking at the S&P 500, let's actually start on the monthly chart, guys. I know the month is not done, but we're going to start here. Now, number one, there's nothing you can tell me, okay, this is bullish. I don't care what's happening right now. I don't care about the news. Look at the price action. On a monthly chart, the S&P 500 is bullish, and any pullbacks, any volatility we get in the market right now, we just want to buy that in the future, okay? Now, on a monthly chart, I remain constructively bullish as long as we're above this level right here, 45.66, okay? The reason I like that level, we used it as resistance right here, and then it turned to support in December and started this next leg up. So on a monthly chart, if let's say we are to pull back, we can pull back all the way to 4,500. It's like 10 or 11%, and I'll be buying dips right here, looking for new all-time highs in the S&P 500. So we can pull back a full 10%. I'm a buyer of dips, and I'll be buying the dips all along the way to this level right here. Now we break below 4,500. Things are still all right in my personal opinion. On a very long-term basis, this is ultimately 4,200 where I see absolute critical support. Below here, and things can get very, very rough. But right now, 4,500, I am constructively bullish. As long as we're above this level right here, we're bullish on a monthly chart. Now on a weekly chart, this is where things start to break down. We can definitely see that we're approaching these levels right here, and that is ugly structure. I don't like that. And I think next week, if we continue the sell-off, we're going to slice right through these levels right here like butter. That's not strong support. It was very, very weak support right here. We had strong support at this level. We definitely did find resistance right there. I'll show you on the daily chart, but these candles right here, I don't like them at all. I think if we are going to sell next week, which I think we are, we're going to slice right through these levels very, very quickly and go to the next plausible levels, which is this right here. So on a weekly chart, right, I'm really looking at this range right here. That's the range. So it's sort of like the open and the wicks. So 49.80 to 49.20. I know it's a big range. It's like 50, 60 points. That's a pretty big range, but that is what I'm looking at on a weekly chart basis. So on the weekly, we pull back to here. I'm going to remain bullish, and then we can buy the dip. If we break below the 49.23 level, okay, and I know it's quite a while, it's like 4 to 5%. If we break this, then we can play shorts all the way to this level right here. But until we actually break this level, I'm a buyer of dips, even in negative gamma. And I do think we're going to find very, very strong support here at the 49.86 or 5,000 level, a psychological level. You know, it was the big level in December when we crossed over it. It was like, wow, we hit 5,000. What a monumental event. So this is a very strong level, you know, this 49.20, 49.80. We break below here, I do see further downside to this level where we probably will find support, and this will be the next low before we make the next leg up in the S&P 500. But ultimately, this is what I'm looking at right now. Now, looking at the daily chart, guys, and something you do want to note first and foremost, we are actually in an uptrend. You can see we put in a low right here and then a higher low here, pretty much all the way up. At the same time, we've also put in higher highs all the way up until we hit this equal high right here. And this is when we've started to see a change in trend, and we have actually flipped into a daily downtrend. Now, still constructively bullish and in an uptrend on the weekly charts as well as the monthly charts, but we are starting to see a break in trend. And I think that break in trend actually started last week with this massive red candle. We put in a low. We then actually did try to rally. We couldn't get above the highs. We pulled all the way back. And then in the last 2 days, we put in equal lows right here with this low. And then we've actually broken below that low right there. So what does that mean? It opens up lower levels for the S&P 500 next week. And the very first level is actually these closes right here. It's that weak weekly structure I was talking about in the weekly chart. This right here, I don't really like. So what I'm looking at for next week is probably the first level, the 50.90 level right here. I think if the bears go ahead and take this level very, very early in the week, I think we're going to go ahead and sell all the way to 49.86. That's what I'm thinking. If the bulls go ahead and hold this 50.90 area where there was weak structure, it just means that that weak structure is now repaired. And that probably means we probably find support and then make a move higher. And then we would need to go and clear some of these highs to confirm that uptrend. So essentially what I'm looking at at is repair of this weak structure right here, move higher. If not, break below, price discovery below, and then capitulation all the way to 49.86. The reason why this is an absolute critical level, it was the Nvidia earnings gap, and it's really what started this last leg higher up to the 5250, 5200 here in the S&P 500. So that's what I'm thinking about next week. We are in a downtrend, guys, in a daily downtrend. So you do want to be conservative, and if you don't want to short, if you don't want to take that risk, sit out the volatility and wait for good dip buying opportunities. One may present itself next week at the 50.90 area. If not, look at 49.86, 49.23 sometime next week. Now I know this is quite a while away. When you look at it, you measure it from there to there, that's a 3.8% move, but we are in negative gamma. We are in a daily downtrend, and in negative gamma we can have wild swings. I mean, just look at today's trade, down 1.46%, 1.66% here in the Nasdaq, 1.78% including after hours, nearly 2% in the IWM. So we can definitely have wild erratic moves in negative gamma and an expansion of volatility. If we do want to look at another key level, I would say the top of this Nvidia earnings gap, 50.37. So you have some very crucial levels that you could look at for the rest of the week right here, 50.90, 50.37, 49.86, 49.23, and especially if we do get below this 50.90 area and use it as resistance, I think that opens up a lot of these lower levels towards the end of the week. Now, we don't have a lot in earnings or data next week. That means that there's not a lot of thesis to support the bull case or the bear case, and a lot of it is just going to come down to flows. And sentiment has shifted in a very big way. This is the fear and greed index. Guys, just yesterday, we were at greed. We were here, 58. We are now closer to the fear zone than we are to the greed zone. Have a look at this. 1 month ago, we were at 73. Just a single month ago, right here. This is where we were a month ago. We are now closer to the fear zone. And this is how quickly sentiment can shift. This is how quickly the retail market gets scared out of their positions. And I do think that we're probably going to enter this fear zone sometime next week. All right, guys, earnings are on deck. They all came out before the open here on Friday. We're going to look at JP Morgan, Wells Fargo, and BlackRock. Otherwise, we will be here forever. Now, I looked at all of the financial earnings, and earnings was pretty good across the board. Earnings guidance, however, was very mixed across all of these stocks, and that's why some of these names sold off more than the market. Overall, financial earnings was actually good. A lot left to be desired with guidance, and I do think that a lot of this was already priced into banks. You know, banks have run up quite significantly. We got beats in both EPS and revenue here for JP Morgan. Pretty significant beats, something like 5 to 6% here for JP Morgan on the EPS side. They also used lower provisions for credit losses. And then total deposits did come in slightly as a miss, and pre-market JP Morgan was down 2%. Now, I did think earnings overall were actually good. I think the market didn't like the total deposits right here, and also the stock is up 13% year to date, outperforming the S&P 500, outperforming the Nasdaq 100. I think it's run a little bit too far, too quickly, and we're sort of getting a buy the rumor, sell the news type of price action in JP Morgan. Now, this is pre-market. I am recording this earnings segment pre-market, and that could change at the end of the day. Looking at Wells Fargo, EPS of $1.20 versus $1.10 expected. They beat on revenue of $20.8 billion. They were up 1.64% in pre-market. BlackRock as well, EPS of $9.81 versus $9.49 on revenues of $4.73 versus $4.7. So revenues just beat, and then assets under management, this is what the market liked, was up $1.4 trillion year over year. That largely has to do with gains in both stocks, cryptos, and commodities, and then they were up pre-market 2.42%. So, you know, these guys make up like 20% of financial earnings, JP Morgan, Wells Fargo, BlackRock. To see them in the good books, even though, you know, JP Morgan didn't perform pre-market as good as you would expect, these are very good earnings, exactly what you want to see in this type of environment. And I think in the earnings report, Jamie Dimon said that there were plenty of economic indicators that were looking very very, very favorable, stuff like that. So, very upbeat earnings across the board. And I think guidance for most of these guys was also pretty good, in line with what the market expected. So we got some stats right here. This is the S&P 500 performance from April 11th to the 20th in the last 50 years. So pretty much what we're going to do in the next 2 weeks of trade, the next 10 trading days. Normally we get some very, very mixed yet positive returns. 35 up years, 15 down years. So a total of 50 data points right here. And you can see the average return 0.71%. So a fairly positive hit rate. You're looking at about a 70% hit rate, but it gets even better when we break down the data a little bit further. This is the S&P 500 performance, April 11th to the 20th, when the first quarter of the year is positive, and then March 31st to April 11th was negative. Essentially, what's the return we can expect? Now, this is completely indicative of our current market conditions, and this is why it's so crucial to have data like this. And you can see we have 14 data points right here. Average return 1.62%, 14 wins, 0 losses, a perfect record. And what the data is telling us is that the volatility we've experienced in the last week and a half is nothing more than a standard dip, and history tells us to stay long into the end of April because the data is on the side of the bulls. Now let's actually talk about what fund managers are doing with their portfolios. So last week, so this is from the 4th of April to the 10th right here. Okay, so it's 5 trading days, 1 week, and you can see outflows in equities of negative 17.22 billion. So a very negative week, and I couldn't actually get the data on what exactly fund managers were buying and selling. So we're going to use the next best thing. And sometimes when it comes to this type of stuff, you don't overcomplicate it. Just pull up a sector chart over the period that you want to cover. Okay, the 4th, 5th, 8th, 9th, and 10th. Okay, 5 trading days. So we had inflows into GDX, energy, metals, mining. That was leading inflows during this period. But we had $17 billion of outflows. So what were fund managers and what were clients selling? At the bottom of the heap, they were selling home builders, down 6.24% rough, along with KRE and XLRE. So pretty much like residential real estate, home construction, and then like commercial real estate. So anything levered to real estate, because rate cut hopes just vanished towards September after the NFP print, after the CPI print. They just wanted to get out of those names. And they were also selling semis, financials, healthcare, technology. So anything cyclical, anything rate sensitive, they just wanted to get out of that. And healthcare was one of those sectors. At the top of the selling, we saw XLP and XLU. So there was less selling in defensives, right, than there were in like these rate sensitive names. So what's that telling us? Fund managers were positioning themselves a bit defensive. They went into GDX, they went into energy, inflation hedges, metals mining right here. They got a bit defensive. They sold less staples, sold less utilities. They were likely just building a bit of cash, and they just completely dumped XLRE, KRE, home builders. So anything in real estate, they just dumped real estate. So that is how you can evaluate stuff like that and put yourself on the right side of the trade. And you don't have to overcomplicate any of these things. But let's actually talk about what caused these outflows. And it had to do with the hot NFP we got last week and the hot CPI we got earlier this week. Now, a couple things I do want you guys to note. The entire CPI report came in cool, except for auto insurance, which increased 22% year over year, and then OER, owner's equivalent rent, and rent as a whole, housing. So shelter and auto insurance were the bulk of the heat we saw in the CPI report. The reason why the PPI report came cool is because if you actually have a look at the PPI premiums for auto insurance, you can see that it's way down here, whereas the CPI insurance is way up here. So essentially, PPI is what like businesses pay, CPI is what you and me pay. You can see that what they're paying for insurance is significantly less, and that's one of the reasons why the PPI print came in a bit cool. Now guys, I want to talk a bit about PPI and CPI and the difference between the two, okay? So let's say you go to a burger joint, okay? Here is our lovely burger. This is our lovely burger right here. And you buy the burger, okay? That is CPI. The restaurant needs to go buy the bread. That is PPI. They need to go buy the hamburger bun. That is PPI. Everything to put the burger together, that's what producers pay. Them selling you the burger, that's what you pay, CPI, consumer price inflation. So oftentimes PPI is a leading indicator to CPI. And we know this to be true because last month CPI came in at 0.6, blew everything out the water. It was actually a hot PPI number. Same here with the year-over-year number, came in hot on both the month-over-month and the year-over-year. What happened this month? PPI came in cool, 0.2, consensus 0.3, year-over-year 2.1, consensus 2.2. And while people will look at this previous number and say, oh my goodness, it came in higher, the truth is the consensus was 2.2, so it actually came in lower. What does that mean? It means prices are actually dropping, and next month that is going to be reflected in the CPI. What did we see with CPI? CPI came in hot this month. What came in hot last month? PPI. So PPI came in hot last month, CPI comes in hot this month. Just think about the economics on how costs are passed on from producers, manufacturers, and then to the consumers. So we got a cool PPI that potentially means we could see a cool CPI next month because PPI came in cool. More supporting evidence of this, we got stuff from BOFA, monthly hardline retail spending snapshot. Okay, hardline spending is actually down 5.6%. Let's read some of this. Hardline spending decelerates year over year across all categories. We provide an update on BAC aggregate debit and credit card consumer spending in hardline retail categories for March 2024. Hardline spending fell 5.6% year over year versus negative 1.8% in February as spending slowed for almost every category we track. See the latest BOFA on USA report, blah, 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 whatever. Home improvement and services spending fell in March, declined 6.4%. Auto parts, services, car wash spending slow. That reminds me, I have to wash my MX-5. It slowed, declined 1.8%. Furnishing and flooring spend down double digits. Guys, and the Fed want to cut rates. They are looking for a reason to cut rates. The Fed have clearly communicated that, and we have to keep that in mind. At the same time, April's CPI data did come in hotter than expected, and that's also something we need to keep in mind. But it could be an outlier month due to Easter. Easter did come earlier this year, and all of that demand does get pulled forward into the early parts of March, and maybe we'll start to see clear deflation, and maybe we'll start to see clear deflation or further disinflation in the April PCE report later this month. And this data right here is somewhat supportive of that. At the same time, what this data right here is also telling us is that the consumer could be slowing in a very big way, in a very material way. And these are risks we need to consider for the rest of 2024. Let's quickly talk earnings very, very quickly, guys. So S&P 500 earnings, it's getting into gear. We're expecting 8.2% here in the fourth quarter of 2024, excluding financials, 8.6%, excluding energy, 12%, double-digit growth. That's crazy. And then excluding financials and energy, 13.2%. Now, revisions. We're seeing revisions are tracking really, really good. This is the historical average. It's tracking well above the historical average and tracking in line excluding COVID, the GFC, and the year 2000 crash. And BOFA actually expects earnings to materially improve into the end of the year, into 2025, into 2024, as you can see right here. Now, at the same time, what's also helping earnings is margins. When you see a demand recovery, like we're seeing right now, margins tend to follow. So this is real sales growth and EBIT margins. And as real sales growth increases, you can also see that margins tend to follow. And this is really, really good because at the end of the day, you want to own equities if earnings are increasing, which we're seeing, as well as margins at the same time. That is the holy grail of stocks. If the volatility we've seen in the market does materialize into something much deeper over the next couple of weeks, we want to be buyers of dips because the fundamental picture is not deteriorating, it's actually improving. And we did speak about that in yesterday's video too. Now, before we get into some charts, let's actually talk about gold, guys. So gold is rallying. It hit 2,400 in the last 24 hours, a record high there in gold. And this is what happens to gold when the Fed stops hiking rates. And the price action we're seeing in gold is actually completely normal. It's following its historical norm. And normally when the Fed pauses, as you can see right here, here, and here, gold tends to consolidate for a bit and then go on blockbuster rallies, especially after the Fed cuts rates. Here in 2000, a 66% return. Here in the GFC, 189% return. Here in the pandemic, 50% return in a very small period of time. And this is where we are right now. Gold is at all-time highs. We're probably going to get rate cuts. We don't know when, June, July, September, December. But when we do expect the gold rally to continue 25, 26, 2700. On my very first video, it was either on the 1st of January or the 31st of December, depending on what time zone you're at. I made my predictions for a whole bunch of indices and sectors and stocks. I said gold to 2400 and we officially hit that. So just crazy. There's probably more upside for gold. You know what? I actually potentially can see 3000, not without consolidation, maybe in a couple of, maybe not this year, but over the next 18 to 24 months. But I think, 3000 is definitely definitely on the table, and gold is looking like it wants to move higher. Now let's talk gamma. Now guys, not much has changed in the GEX chart. The gamma flip zone continues to be 5200. It actually moved down 5 points to 5195. Very interesting. Put support still at 5000. Call gamma resistance still at 5300. You want to buy dips, sell rips above this gamma flip zone and below. You just want to wait out the volatility. Maybe look at getting into some major long positions at 5100, 5000. They seem to be areas of contention. But as it is right now, there's not much to go on looking into next week, looking into OPEX. Negative gamma still remains very elevated, and the second we get below the 5200, we are going to see elevated volatility and expansion of volatility. That'll coincide with an uptick in the VIX, and above it I do think we'll see volatility compression. Do take into consideration heading into next week, there is a little bit of positive gamma just above the 5100 strike. So if we do pull back early next week into this area right here, we could definitely use it as some very solid support, because there is some positive gamma. That is actually quite significant in the grand scheme of things. What you guys don't realize is that actually is positive gamma all along here. It's just so small you can't even see it. So when it perks up like this, like that, it's actually pretty significant, and it can have an effect on the market, a supportive effect. So yeah, if we do get into negative gamma, 5100, 5000, above here, look to 5300 directly. Guys, so today I'm going to be providing you an update on a couple of the portfolios here that I've provided for you guys. So the first one is the undervalued portfolio. This is a fantastic little stock portfolio right here. I gave this portfolio to you guys on Twitter on the 21st of December 2023 for 2024. Now it currently has 10 positions, and if we actually scroll down to the Twitter post, we actually are officially out of ACN for the second quarter of 2024, and Fortinet is in. So the current holdings are Fortinet, Nvidia, ASML, Barber, CRM, Cisco Systems, F5, Google, Schwab, PayPal, AXP. Now let's go back to Google Finance, and you can actually see the holdings right here. So ACN is officially out, and we have Fortinet come into the portfolio on March 27th. And I'm very happy with how this portfolio has performed. If we go to total gain, which would be from the 1st of January, or when the market opened the 2nd, we can actually see the best performing holding right here is Nvidia, followed by stuff like ASML, American Express. Salesforce has done really well. An underachiever, Google, up 15% this year. People say it's out of the Magnificent Seven, but that's a great gain. For one quarter in a stock, that's really good. PayPal is up 7% for the year. That's very interesting. Now, comparing it to the S&P 500, so year to date, the portfolio has returned 17.47%. You can see it's completely outperformed the S&P 500, almost doubling it for the most part. In the last 5 days, we've had quite a lot of volatility in the market. Now, guys, do take into consideration this is pre-market open on Friday when I'm recording this for this portfolio. You can see that the S&P 500 has been in a drawdown. Our portfolio didn't go into a drawdown in the last 5 days. We had a bit of a pullback from the highs, but the truth is whenever you have a pullback from the highs, right, but you don't go into a drawdown, it's far better on your emotions. And so it's completely outperformed the S&P 500 in that regard. You can even see in the last month, ever so slightly outperforming the S&P 500. And yeah, year to date, just completely outperforming it, which is what you want to see in a portfolio. Now let's have a look at another one of my portfolios, and this is the YouTube public portfolio. So the public portfolio is just a portfolio that we started a couple of weeks ago. Pretty much all the revenue from YouTube we're going to be putting into a single portfolio, buying stocks that we like, focused on long-term capital appreciation, and we're just going to see where this goes. Right now it consists of PayPal and Google. Google's average cost is 138. It consists of 43% of the portfolio. That's the current value, and that's the total return, 15.3%. So we've nearly caught the full move in Google since the lows in early March. PayPal is the newest addition. That's the size right there. That's the total return so far. And I do think PayPal is severely undervalued, and I think the market has mispriced it. And over the next couple of quarters, we should see the stock re-rate. If the stock doesn't re-rate in the next couple of quarters, I will be out of it. Management have until Q3 2024 to execute. If they don't, I'm out. Next stock on the list, one of them is Hims and Her Health. Another one is Indie Semi. Third one is a real estate company called Triple H. There's plenty of others. Those are just the ones I can remember off the top of my head. But this is the portfolio currently, and you can see that the total return of the portfolio is $72. doing so well, guys, and it's a 6.46% return, which I'm very happy with. The goal of this portfolio is anywhere from 15 to 20% annualized returns. So we're going to see if we can actually get that. I mean, that's what everybody wants in their portfolio, but yeah, we're just having a bit of fun with it. Just something to keep you guys engaged. If you want to follow this portfolio in real time, then you guys can go ahead and do that. But yeah, Google and PayPal are the only two positions. And I'm going to keep this portfolio very concentrated. It's going to consist of at most 6 positions, and then that's probably going to be it, and then we'll just add to it. So right now it's Google and PayPal. We'll see what other stocks I get my hands on. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.